and welcome to Business Morning. I am Bisi Adebayo. Let's begin with crude oil futures with extended gains today after a bigger than expected draw in U.S. crude stockpiles and as solid U.S. and Chinese factory activity fueled optimism of a recovery from the pandemic, boosted investor risk appetite. Brent crude futures were up 0.86% to $45.97 a barrel in early trade, extending gains into a third day. U.S. WTI futures rose 0.94% to $43.16 a barrel, and that followed the previous day's gain as well. Meanwhile, the Reuters survey found that oil output by the Organization of Petroleum Exporting Countries rose by about 1 million barrels per day in August. From May the 1st, OPEC and allies, known as OPEC Plus, made a record cut of 9.7 million barrels per day, or 10% of global output, after the virus destroyed a third of world demand. From August the 1st, the cut tapered to 7.7 million barrels per day until December. And back home, the National Pension Commission and the National Insurance Commission have signed off the guidelines on group life insurance policy for employees and CPS retiree annuity. The landmark event, which is the outcome of the collaborative efforts of both regulators, also included the signing of a memorandum of understanding. The revised regulations and guidelines provide clarity on the Pensions Reform Act 2014 in areas relating to retiree life annuity, such as ensuring safety of retiree life annuity funds and assets, prevent mis-selling by pension and insurance operators, and bringing stability into the financial sector of the economy. More headlines now. The Federal Competition and Consumer Protection Commission has opened an investigation into consumer complaints with services offered by dominant pay TV operators in the country. In a statement released yesterday, the Chief Executive Officer of the FCCPC, Mr. Babatunde Irukera, says that the inquiry seeks to address issues relating to unfair dealings, abuse of market power, unfair pricing, and other illegal conducts. Mr. Irukera adds that in the last 2 years, the FCCPC has conducted investigation, pursued legal action in court, secured an injunction preempting price increase by one of the dominant pay TV providers, and will continue to ensure fairness to consumers in the country. Now, following the resumption of FX sales to Bureau de Change dealers by the central bank, the foreign exchange market has seen some respite as the Naira maintains a trajectory within the last 2 days of improved access to FX. The Naira improved marginally by 0.02% at the I&E window on Monday and gained 2.6% to 465 Naira per dollar at the parallel market on that same day. And yesterday, Tuesday, we saw the local currency close flat at the NAFEX window, but further appreciated by 5.7% to 440 Naira per dollar at the retail street segment. Analysts had projected that the central bank's resumption of FX sales to BDCs will inject more liquidity into the retail end of the FX market. But how much of appreciation or stability should be expected in the Naira? Well, this is the focus of our conversation this morning with the president of the Association of Bureau de Change Operators of Nigeria, Mr. Aminu Gwadabe. Good morning, Mr. Gwadabe. Thanks for joining us on the program. Now, tell us, how has the market been for you as a dealer since Monday?
Good morning for your time. We want to use this medium to sincerely thank the management of the Central Bank of Nigeria for resuming sales to the Bureau de Change by Monday next week. The market has been quite appreciating in terms of the Naira value. The pandemic, the Naira also been getting recovery from the pandemic, if I can say so. The BDC vaccine that the CBN have long discovered is working, as we are witnessing in the market, because the local currency have appreciated by over 5%. We see appreciation from 477 to $1 to now about 440. So which means Naira have gained about 37 Naira to $1. So it's quite remarkable. And we hope that the trajectory will continue, though we expect some challenges as we continue to unveil this storm.
The directive of the CBN is that the BDCs should sell at a cap of 386 naira per dollar to end users. Has this directive taken effect?
Honestly, that's a challenge that we are all reviewing and looking at. And that's why we're having a webinar meeting for all our members today. But we will appreciate a kind of, because we only have 2 naira margin, we are buying 384 and to sell at 386. So considering what market is doing today at 440, so you can see 386 and 440, there's still a little of kind of imbalances. So we want to appeal to the Central Bank of Nigeria to review our margin from 2 naira. The standard all over the world, the minimum is 6%. So we are looking for a review so that our members can operate within profit. Because 2 naira cannot cover our cost, we have been shut down for 6 months, paying rent, salaries, even official fees in terms of taxes and state revenue. So it's tough for our members, but we are appealing to the Central Bank of Nigeria to look at that margin so that we can really perform our role effectively. But we will do it. The BDC has been doing it from 2006, 2015, and 2020. I'm sure we will keep up to the mandate of the Central Bank of Nigeria. We'll try our best.
Now, just like you mentioned earlier, the naira closed higher at 440 to the dollar. But what then happens to the value of previous FX that dealers had purchased at higher rate?
Honestly, I want to advise the general public that this is not the time for holding, this is not the time for speculation, because people have burned their fingers. And remember, the $20,000 weekly is at the first instance. So the CBN is strategic. They can come up with intervention in any day, and that will mean further losses for people that want to keep. People are taking losses. Even the whole financial system now is doing that band of 440, 445. Even remittances, that's what they are going. I mean, in terms of transfer. So we are witnessing huge appreciation, and this should be a sign for people to desist from behaviors that will make them lose money.
Well, then how have dealers been managing to cushion the effects of the losses of their previous stock?
When people are dumping, we are witnessing dumping, if I will use that word. Like a lot of people are dumping their holdings and taking a loss because the trajectory will be, the appreciation will continue. Imagine just the pronouncement. This is what we are. How about by Monday, when liquidity of about $100 million is going to come into the economy? And we want to advise our members, they should not sell to unauthorized buyers. We are not allowed to sell to unauthorized buyers. We are only allowed to sell to travelers, to payment for school fees, subscriptions, mortgages, and whatnot. So if we look at that scope, $100 million should be enough liquidity to continue to defend the naira strength.
Now, international flights are resuming soon. How much impact do you expect this latest development to actually have on FX rates?
In fact, it will have more impact because Matthew will be having a lot of our working customers, those that will be coming from abroad, that will add to the one window, the IMTSO window that we're accessing to the Central Bank of Nigeria. Because we are the most vulnerable also in terms of shutdown of the airline. We lost completely our working customers. Because when we don't have travelers coming in, we're not going to have sources. So with the opening of the airline, we expect our customers to come, Nigerians will come home, will come with dollars, visitors will come, they will come with dollars, so it will widen our horizons of source and also impact positively into the economy.
But considering the $10,000 weekly volume to each of the over 3,000 BDCs now, are you actually positive that your members would be able to meet the huge demand for FX when the international flight operation resumes?
Just to make a correction, it's not $10,000 weekly, it's $20,000 weekly. And we have about 5,000 British change license. So if you graduate that, you are taking $100 million weekly. So that's what we're going to be expecting. into the market. And then what's the second question again?
Asking if they would actually be able to meet the huge demand for FX when the international flights actually resume.
Oh, good. The central bank has been introducing varying degree of measures to checkmate fragility in the market. What we witnessed during this pandemic is nothing more than holding as inflation and rent seeking. They have come up with product price mechanism verification, that's in terms of ensuring from them are not being abused. They have come up with due diligence on export policy. They are tracking export profits in the economy. So all these are measures that the CBN have adopted to ensure that unwanted demand are not allowed into the system. So once they can block the loopholes like this, and two, the security agencies should come up also to their living, ensuring that our borders and our ports are also being checkmated so that they can implement the policy of the Central Bank of Nigeria.
Well, I'm sure many would like to know, Mr. Gwadabe, how low should we expect the dollar to fall by this time next week?
By this time next week, we should be expecting between 410 415, tentatively. Even though it's difficult to predict Naira, but I'm sure with the liquidity coming in by next week, we are going to see more appreciation of Naira in the economy. So don't speculate, don't keep. Bring up your dollar.
President of the Association of Bureau de Change Operators of Nigeria, Mr. Aminu Gwadabe, thanks for sharing some of your time with us this morning. Now, lately, the central bank has been reeling out several circulars, all in a bid to sanitize the financial market environment, which has actually been complicated by the effects of the COVID-19 pandemic. But the most recent policy that we've seen from the regulator is the directive on minimum interest rate on savings deposits, which has now been reduced to a minimum of 10% of the monetary policy rate, or 1.25% of the current MPR of 12.5%. And that new directive, which took effect yesterday, September the 1st, is a clear departure from the previous minimum of 30% of MPR, or 3.7% or 3.75% policy that obtained before now. And one of the objectives of the monetary policy as contained in the CBN circular is to help banks to cushion the effects of their credit flows to the real sector, effective yesterday, Tuesday, September the 1st, 2020. Well, joining us now to make sense of this new policy is the Chief Executive Officer of Leishton Consulting and Board Gov, Dr. Macleish Otwedan. Good morning, Mr. Otwedan. Thanks for coming on the program.
Hey, thank you very much, and thank you for having me.
All right, let's begin this conversation with you giving us your impression of this new policy from the CBN. Do you think it's necessary, and why?
Thank you, and viewers. I think if you look at the trend, it starts from what is the CBN saying in the market, and if you look at it, you find out that other rates are also trending downwards. Most countries, we always look at your treasury bills rate, and so if you look at the 90-day, the 182-day, it's been trending somewhat 1.4, 1.18 respectively. And so what that tells you is that your savings account deposit rate is not sustainable to be at 3.75%, which is when you look at that benchmark of 30% against the CBN monetary policy rate. And so that tells you that there needs to be proper alignment. And I think what CBN has done is to actually align the risk-free rate of savings account to align with the other risk-free rate, which is your treasury bills. And so you have it now 10% of the MPR, which takes it to about 1.25, right? But I think the whole ulabalu about the 10% was the way it was captured in the circular. And so people were thinking it was outright 10% interest rate on savings account. And so it's good for depositors to understand, first of all, that it is not an outright 10% per annum on their deposit.
So what is it?
It is 10% on the monetary policy rate. And the last monetary policy rate was, which was retained in July, was 12.5%. And so when you look at 10% of 12.5 gives you 1.25, right? But this is not really supposed to be a matter that should really be topical, because if you look at from 2013, when CBN started having what you would call when CBN issued the revised guide to bank charges, that was in March 2013. It was outrightly 30%. And in 2017, when the guide to charges for banks and non-banking financial, it was also 13. And the circular that was issued on the guide to bank charges for 20th of December 2019, which came into effect on the 1st of January 2020, was actually 30% of the MPR. So it has always been. But when you see a circular come out like the way this did, it's also important for our regulators to have that understanding that their stakeholders goes beyond the target, which is the deposit money banks. And so you need to, first of all, even state explicitly, it shouldn't be implied, the objective, and also make the other stakeholders to understand that this is on the MPR, even though it was stated, but it wasn't really, as in, you need to be a financially literate person to actually understand what that meant. So we need
more clarity, that's what you're saying.
It's always definitely, so one paragraph would have been made it clear. So it would not have really been an headline, because it is just updating your guide to charges for banks, financial and non-banking financial institutions that came into effect in January 2020.
So whether we have, that much clarity or not, of course, from what you're saying, the customers really have nothing to worry about. But the policy implies a reduction in banks' funding costs. So tell us what will be the implication for customer deposits, or how negative it will be for customers. I'm sure many would like to know that still.
Definitely, if your interest rate is, so I think it's basic. If you are earning 3.75, then suddenly it comes to 1.25. That is more than a 50% reduction. And so it has direct implication. But so when you look at the whole concept of interest rate in Nigeria, it's convoluted. And first of all, you also have banks having a challenge, which is, what is the challenge? There is the loan to deposit ratio of 65% that they need to offer. And so the question is that when I have to give a loan as a bank, you are giving that loan to people who you think can repay those loans, right? And so the question is, if you are, first of all, your cost of funding of savings account is 3%, and on the other end, you are supposed to be giving it out, but you are not able. And there's a penalty from CBN, which is the differential between the amount you're able to give and the 65% would have to have additional, CRR, which is the cash reserve ratio of 50%. So there's also an implication. And so what you begin to look at, okay, how do you strike a balance within the system? And that is on the one hand now. So you have, now this will be favorable to the banks because one, it's reduction in the cost of funding. But if you also look at it, it's also has an adverse effect on the deposit, the retail sector, because really most of the savings account are for the retail sector. But the other thing you also look at is how does this whole reduction now come into play with regard to financial inclusion? Because you actually want people, retail customers, you want to bring them into the banking system. And so the question is that what are the alternative assets that they are going to be looking at right now? So it becomes, so will it be better for them to put it on the bottom of their pillows rather than bringing it to the bank? Because they will say, look, there's already a challenge before now, because there's already a caveat, which is that you won't enjoy even the 30% as it were, and even this if you withdraw more than 4 times in a month.
Okay.
But what I've also noticed is that most of the retail depositors typically withdraw more than that, and so they are likely not to benefit. So,
All right, Mr. Otweno, please just hold on to your thoughts. We'll continue this
thank you
conversation
very much.
shortly. We'll be back in just a moment. Please stay with us. Welcome back. We still have with us the Chief Executive Officer of Relation Consulting and Board Gov, Mr. Maklaish Otwedon, here with us in the studio, and he's talking about the CBN's new policy on retail banking. Thank you, Mr. Otwedon, for staying with us.
Thank you very much.
All right, so let's continue the conversation now. Of course, some analysts are of the view that this policy might be insignificant for most savings accounts, and that's due to the stringent withdrawal limits, which is, of course, just like you mentioned, once the withdrawal exceeds 3 times in a month, an account holder becomes ineligible for this interest. Do you agree that these conditions should limit the effectiveness of this policy?
Definitely. I think it is good because if you look at most savings accounts in Nigeria, it's mostly the retail sector, and most of the retail depositors really, in fact, more often than not, they will withdraw more than 4 times, right? But if you have left the rate, so there's the issue of arbitrage, right? If the rate has been left at 3.75 and you have other risk-free assets significantly lower, then you will see those that are above the retail sector come into the deposit savings account. And so the implication of that is then it will have a significant effect, right? But because it has been brought down, then there will be no much incentive for those major players to come into that space. But so overall, it won't have a material effect. But again, if you look at it, even the cost of funding has actually been very low for some banks. So we don't expect much. But overall, from a Nigerian perspective, the aspiration and hope is that the overall cost of borrowing, right, to the real sector should significantly come down. And so I'm still very hopeful that one day we will get to a situation where we can bring the cost of borrowing to a single digit, and that will be very good for the country. But we can, so it is very important for the regulator, the CBN, to not just end with this, but also look at what are some of the interventions. And again, you can give credit to CBN for the LDR strategy, which has also made banks to be more committed to giving more attention to the risk sector, and also some of the intervention with regard to the restrictions to treasury bills for retail investors. And so those are really, in terms of even the open market operations and all that for non-banking corporate. So there's really be a lot of interventions. But again, what I will always believe from a Nigerian perspective is that there must be a whole level of rigor and an helicopter view of how some of these policies have interplay and affect the different stakeholders within the system, so that at the end of the day, then there will be a purpose, an objective, and that objective should be for the overall benefit of the Nigerian economy.
Now, possibly talking about, of course, some of the CBN interventions that you mentioned. Of course, the CBN says it's satisfied with the recent declining trend in market rates in the banking sector, and that follows the implementation of some of its economic stimulating policies. So tell us, what role did the minimum lending rate of 65% and the exclusion of the non-bank corporates from OMO auctions play in this regard?
So if you look at what was happening prior to some of these interventions, then it will become very clear in terms of the what has been achieved. So before now, you found out that depositors come in, a lot of deposit come in, and what happens? You give the depositors 3%, 3.75, but at a time, Treasury bills was going for as high as 20%. 18% and other. But again, you find out that generally in finance investment, it's always very clear. If I can have what you call invest in a risk-free asset, like treasury bills, right, and I get a return of 17%, what is the motivation for me to go to the risk sector and invest? It is pretty difficult. But when CBN started with that and now brought these, so when you stop that as a regulator to say restriction to, retail and all that with regard to treasury bills and the OMO for non-banking corporate. What it does is that, okay, where should the banks now put these funds, right? And so something that would be reasonable was what CBN did, which was to say, okay, 65%, I think it started from 58, of your deposit must go to lending. And they mentioned some specific risk sector that it must even go as far as 150%. And so what that does is that, it forces the hands of the deposit money banks to now put funding, and to really fund the risk sector. And what you have with that is that, which is what we need, because you want to be able to fund the issue of production, because that is what will create jobs in the country. And I'm a firm believer in Nigeria that, look, we need to create jobs. And how to create jobs is to fund the risk sector and also use our regulations, our laws, be intentional about those laws to ensure that it creates opportunities, activities that would definitely create jobs. So you can see that has significantly impacted. And again, enforcement is also key. And so CBN has been very bullish in terms of its enforcement to ensure that once you are not able to meet that minimum of 65%, then the differential is subjected to the 50% rate. And so we expect more intervention. And I always say, ultimately, if we don't get to where these interest rates to the risk sector comes down significantly, then we wouldn't have really achieved what I think it should be the ultimate goal.
Now, when you look at the half-year financial results of one of the Tier 1 lenders, which was released late yesterday, it wasn't impressive, even though they offered to pay dividends from their retained earnings. What do you see the interest rate regime changing for such banks during this pandemic period of COVID-19?
So it's, there are some years in the history of the world that have been very challenging, and you can remember for the children of students of history, the Great Depression of the late 20s and the 1920s and early 1930s was very significant. Then the global financial crisis of 2008 was another significant time. And if you look at it, it means that all hands must be on deck. And not only the monetary policy side now, but the fiscal policy would have to come to play. But if you look at from the banking perspective, what the banks, which is what they've already started doing, which is look at how they can channel money to the risk sector. But what we also hope is that if the banks are doing their part, but if we as the government, the fiscal side, are not able to concentrate and mitigate the effect of COVID, then the impact is going to, it's also have what they call a spiral negative effect on every sector of the economy. But what I also believe from the banking side is to now also begin to look at opportunities. So first of all, you have this reduction in their cost of funds now. We have little impact on the cost of the funds that they get, so which is positive. Then they also look at other avenue in terms of what are the sectors that are more lucrative right now, investment friendly, and begin to channel. But at the end of the day, you have to take 2020 as a year that would have some missed challenges. For some, it will be good. And if you also look at it, in terms of the online banking activities has also been, a phenomenon. And so they will also take advantage of. If you also look at it again, the FX volatility from a banking side, a lot of banks have benefited from the volatility. And so at the end of the day, some banks will still come out pretty good, and some of them will face challenges. But I believe that as much as we are able to tackle COVID challenges and bring the country to normalcy, then 2021 we should come out pretty good.
Yes, you say that some banks will come out pretty good, but then it's also estimated that the impacts of this policy, when you look at it on banks' earnings, will average an increase of around 8% growth in the 2020 profit before tax. Do you actually agree with that?
Yes, I agree with that, because if you look at a lot of this intervention, and that is why it's good to have a regulator that is very active and sometimes ready to support the system. And what we're talking about savings account now, if you look at it, is the regulator having the lens to see that, look, we need to balance the interplay, the interest within the system, right? So depositors, you need to, because I told you, like, if you bring all these deposits into the bank and they are not able to also give that to borrowers, then there's always a challenge, because you're going to have idle funds. And what would that imply to the economy? What it means is that banks will get to a stage where they will be turning depositors back. We're going to get to that, where, because it's not attractive. And so this intervention, for me, at the end of the day, are aligned with those predictions that, year on year would over around maybe between 5 and maybe 8%.
Now, when you look at banks like GT Bank and Zenith Bank, which are banks that already have lower funding costs compared to other lenders, how much of benefits do they stand to gain from this policy?
They don't really stand. It's almost insignificant for them, because it's already very low for them. So I really don't see much for them. I think for them it's just business as usual. And like I've also said, is that the overall policy really is not something that ought to have actually made any headline, if not for the fact that when certain depositors, individuals, saw the 10%, there was a lot of excitement that, 10%, wow. Because if you look at 10%, you ask yourself, if then that means we've even given up hope if it was really absolute 10% per annum on. So with that, GT Banks, they already have low cost of funding, and I really don't expect much change. And like I told you, there's also an alignment with the other rates, like the 90-day rate for Treasury bills. I think it's about 1.14%. For 192 days, about, I think, 1.84%. And for 364 days, I think about 3.4%. So it means that your Treasury bill rate were actually lower than your savings account rate. So at the end of the day, there needs to be proper alignment. And I think CBN has done the right thing. But like I've said, our regulators, which is, as a researcher, one of the things I also struggle with is the fact that regulators need to understand that the consumer of their information is not just sometimes those that they've targeted. And so there must be some intentionality to ensure that, proper objective is stated explicitly in such circulars, to ensure that people have a clearer perspective on the intention of the regulator.
I'm sure they've taken note of that. We'd like to thank you, Chief Executive Officer of Relation Consulting and WorldGov, Dr. Macleish Otwedo. Thank you for coming on the program.
Thank you very much, and thanks to the viewers also. It's a pleasure.
Let's just do a quick recap of activities at the crude oil market. As at this morning, the crude oil futures are actually extending gains today after a bigger than expected draw in U.S. crude stockpiles, and as solid U.S. and Chinese factory activity fueled optimism of a recovery from the pandemic, boosting investor risk appetite. And Brent crude futures were up 0.86% at $45.97 a barrel in early trade, extending gains into a third day. Now, U.S. WTI futures rose 0.9% at $43.16 a barrel, and that also followed previous day's gains. Meanwhile, a Reuters survey found that oil output by the Organization of Petroleum Exporting Countries rose by about 1 million barrels per day in August. And from May the 1st, OPEC and its allies, known as OPEC Plus, made a record cut of 9.7 million barrels per day, or 10% of global output, after the virus destroyed a third of world demand. From August the 1st, the cut tapered to 7.7 million barrels per day until December. Of course, we have our eyes on this market, and we'll continue to bring you updates as they come in. But for now, let's get a review of yesterday's trading activities at the Nigerian equities market with Edidiong Iwang. Good morning, Eddie. It was another positive outing yesterday at the market.
Good morning, BC. You're right. The market sustained August gains, and that was due to buying interest on Nigerian breweries and some banking stocks. Now, that pushed the all-share index up 0.34% to 25,413.76 points. Now, the year-to-date losses have moderated to about minus 5.3%. The equity cap is at 13.258 trillion. Now, we saw a huge number of volumes traded yesterday. We saw 1.07 billion units, and that was due to UAC prop, which had about 947.74 million units traded. The value and deals were lower yesterday. We saw just about 2.10 billion naira worth 3,221 deals. The sectoral chart was mostly positive yesterday. The banking index was up 1.07% as most lenders posted gains yesterday, apart from FCMB and Zenith Bank. Consumer goods was also up. Of course, that was due to the gains on Nigerian breweries and Vitafoam. Industrial goods declined yesterday. That was because Dangote Cement declined yesterday, but then Boa Cement and Lafarge Wapco were up. Insurance was up 0.65%, while the oil and gas counter was unchanged. Well, let's talk to Mr. Jamil Mohammed, a stockbroker with APT Securities Limited, for more. Good morning, Mr. Mohammed. Thank you for joining us on the program.
Good morning to everybody.
So UBA has released its earnings for the period ended June 2020. Now, the lender is proposing a dividend of 17 kobo per share from its retained earnings. Why would UBA be paying dividends when they haven't made any profits for the period?
Thank you very much, and it's a pleasure to be here. What actually happened in the result is not that they did not make any profit within the bill. Rather, there is a decline in what they made in last year, 2019 half year. So when you look at what was made last year, there is a drop from what they made last year compared to what they made this year. So that is why, even if you look at the interim dividend paid last year, it was 20 kobo. That is why they have to come down and pay 17 kobo this year. It was as a result of decline in the bottom line of the bank.
Thank you for that clarification. But UAC Prop was the most traded stock by volume and value yesterday. We saw about 947.74 million shares traded. Was it a case of cross-dealing, or what exactly was it?
Yes, there is a cross-deal within the same house, and the seller and the buyer is from the same house. So what it means is that there is a major divestment from one of the major shareholder of UAC property. No, recently we received an information in the market that Custodian Investment is ready to take 51% of UAC Properties shareholding. So we believe that it's as a result of UAC divesting its major stakeholding in UAC Property that give rise to that kind of trading yesterday. It was actually a cross deal within the same house, and it was at a price below the market price, and that's why the market price is not affected with the cross deal.
Okay, so the market started the week and the month positive. So what is your outlook for today's trading?
The outlook for today's trading, I'm expecting that the market will a little bit slow down today because we have the two trading sessions for the week has been positive, and I'm of the opinion that the market will have about these 2 days loss, 3 days gain, or 3 days loss, but the market trajectory is always an upward trend. What I believe is that the market may likely slow down. The reason why we think it's going to slow down is because of the fact that we had 2 days positive trend in the week. So it may be a bit of a trending down today.
Thank you, Mr. Mohammed, for your input on the program. Jamil Mohammed is a stockbroker with APT Securities Limited. Well, we'll have to take a break now. Over to you, BC.
All right, Eddie, we'll be coming back to you in just a bit. Plus, we'll see what's happening at the London markets in just a moment. Please stay with us. Welcome back. Now, let's see what stories are driving the markets in the UK this morning. And Juliana Olayinka is waiting to tell us. Good morning, Juliana. Well, let's begin with this report from the Nationwide saying that house prices have reached an all-time high of 16 years. What would you tell us more about this?
Yes, well, Nationwide, the second biggest mortgage lender in Britain, has released their house price index showing that in August, house prices rose by 2%. In July, house prices rose by 1.8%. So that 0.2% is the biggest month-on-month increase that we've seen in this country for 16 years. I've got to tell you, that really pushed up the FTSE All-Share this morning. Yesterday was a pretty bad day on the FTSE. In fact, it closed at its worst state since May, so since during lockdown. And house builders are really leading that rise. Barratt Developments, their shares rose by about 4.5% this morning. A lot of people are looking at these figures. They're not sure whether or not they are going to be sustainable. But the housing market was one of the first markets to reopen sometime back in late May. And since the reopening, it appears as if there is a surge for people to look for homes as they try out this new working from home lifestyle. So a lot of people are moving outside of London in nicer accommodations with a good bookcase background and a large kitchen that they can enjoy their remote working from. So the average house price in the UK is now about £235,000. But of course, if you want to live in the capital, you can double your money. So it's probably worth about £500,000.
Millions of pupils in England are returning to school after the unprecedented shutdown that linked to the coronavirus pandemic. But how enthusiastic are the pupils and their parents about this, especially as cases of the virus are still being reported daily?
Well, yes, well, millions of pupils in England have started going back to school. They started going back yesterday, and some are starting back today, including my daughter. You know, we have seen pupils go back to school in Scotland and Northern Ireland over the past couple of weeks. Of course, education has been a major issue for the British government. First, it started off with that exam fiasco and the algorithm U-turn. And then, of course, masks. Nicola Sturgeon, the First Minister of Scotland, was the first devolved government minister to make it mandatory for pupils over the age of 12. So if you're in secondary school, which is high school here in the United Kingdom, you would have to wear a mask. Now, Boris Johnson has kind of followed those rules, but only for areas where there have been regional lockdowns, for example, in Greater Manchester. So it isn't necessarily compulsory for students in England to wear masks. But if social distancing is going to be a huge factor, then masks will be worn. I suppose really what the government have been trying to do over the past couple of weeks is to ensure parents and also ensure union leaders and teachers that schools are safe. A lot of professors and scientists have been coming out with information saying, for example, it's 20 times more likely your child will die in a freak accident than die of the coronavirus. But we'll see what the numbers suggest last week before the summer holidays. Of course, we know that Gavin Williamson, the Education Secretary, did try and get pupils back into school. It didn't work. But after 5 months of restless working at home and playing on YouTube, I'm sure parents and students alike are just happy to get back in the playground and learning again.
I can only imagine, Juliana. Now, on Wednesday, ministers announced details of how companies can use the Kickstart program, which aims to create thousands of new jobs for 16 to 24-year-olds. But are employers actually ready to help to prevent a lost generation of young people, even as some of them have suffered the negative impact of COVID-19 on their businesses?
Well, I'm not sure, and we won't know because the scheme is just kick-started today. But that's the plan. £2 billion is what Chancellor Rishi Sunak has put into this Kickstart programme. It will run from today until the end of December 2021, and there will be no cap on youths aged between 16 to 24 to apply for this scheme. So if you're in universal credit, which means you're not in higher education and you're applying for state benefits. The government will fund up to 25 hours of employment at a firm, at a company who is willing to take on this assignment of retraining or using or utilising the skills of these young people, as well as paying for their employment. The government will also give the employers £1,500 so they can really shape and tailor some of the programmes that they're going to be offering these youths. I believe one of the reasons why this was mentioned and announced during the government's spring budget statement, if you like, a couple of months ago is because we've seen that a lot of sectors that are proportionately or disproportionately affected by COVID-19 are working environments where we see a lot of people, a lot of young people, especially students, like retail and hospitality. Many of the 9 million people furloughed are from that age demographic, and there are fears that those will be losing their jobs at the end of October when the furlough scheme comes to an end. So they've got this kickstart scheme. It starts today, and we'll see over the next couple of weeks whether or not employers are willing to take on this humongous task that the government need to fill.
All right, Juliana, thank you. We'll see you again in the afternoon.
Thank you.
And it's back now to Ediding for a review of the debt and currencies market.
Thank you, BC. Just before we go to the fixed income market, the NASD OTC market closed yesterday's session negative by 0.24% to 709.45 points. And that's after, staying unchanged for the last two sessions. The market cap was also lower at 521.14 billion naira. Activity level was slightly better yesterday. We saw 49,753 units worth 2.38 million naira traded in 7 deals. Now, the bond market was bearish yesterday as average yields increased by about 3 basis points. Now, across the curve, yields on the short end expanded while yields on the mid and the long end contracted. We had 36 deals worth 22.90 billion naira. The Treasury bills market was quiet yesterday. As you can see, we had just 2 deals worth 750 million naira. While at the OMO market, yields were bullish as the average OMO yield declined. Yield on the long end of the curve declined yesterday, while the mid and the short end were unchanged. We had 53 deals worth 80.65 billion naira. But I'll be talking to Choma Udo now, a fixed income dealer at GT Bank for more. Good morning, Choma. Thank you for joining us on the program.
Good morning. Thanks for having me.
What is your assessment of the fixed income market for the month of August?
Eddie, we started the market very, very quiet. The bond market is trading slightly above auction level, as market is not very comfortable with single digits because of the duration. The rates are in the range of 3 to 10% on the 22 and 30 years respectively. Material states stop trading, barring any significant offer at the moment. We have a maturity of about 320 billion for almost coming in tomorrow, and we expect that the CBN will come in and try to roll over that amount.
Okay, Chuma, just before I let you go, what is your outlook for trading today, and how do you see activity in that space for the month of September?
It's still going to be slow because we have a lot of liquidity and there are no assets to take them out. So we're going to see a lot of traders try to guard their fruits, even if they set offers. But it's basically going to be a bullish bias because of the level of liquidity we expect coming into the market this month.
All right, Choma, thank you for your input on the program and enjoy the rest of your day. Choma Udu is a fixed income dealer at GT Bank. We'll have to leave it here on the market review. Over to you, BC.
We always hope for a profitable trading day. Thank you, Eddie. And that's our program today. Thank you for watching. I am BC Adebayo.